Welcome back to the channel. I'm the Swedish dividend investor. So guys, today, as the title suggests, we are going to search for an alternative to the American ETF VTI for us European investors. Now, I want to make it clear, I don't like these types of ETFs, since it's always the same. The top 10 holdings are comprised of overvalued American tech companies, and that to me screams risk like nothing else. With that being said, they have a pretty decent performance. If you bought after the financial crisis, you would have made over 750%. I get that many of you are into passive investing and are fine with a 1 to 3% dividend yield and some price appreciation each year. The suggestion came from Akshay Pottar 1840. Sorry for the butchering of your name. He wrote, "Could you do a VTI equivalent ETF for the UK? And as far as I know, UK investors can still invest in UCITS ETFs. So let's start by looking at the original fund VTI. Before we begin, make sure to read the disclaimer in the description. Also, don't forget to like the video and subscribe if you haven't already." So we head on over to Vanguard and check it out. VTI, Vanguard Total Stock Market ETF. We can see the expense ratio is sitting at an almost silly level of 0.03%. That's very good. More money for you. We also see that fat and juicy dividend yield of 1.14%. I'm sorry if I sound bitter, but that is pretty minuscule. We also see they invest in large, mid and small cap stocks. If we scroll down, we can see the fund total assets as the making of this video is $1.9 trillion. They have 3,526 stocks in their ETF. Jesus Christ, that's a lot of companies. Earnings growth of 22.5% and an insane PE of 26.8. If we look at their holdings, we see a tech at a staggering 37%. Followed by consumer discretionary at 14.4%. Why can't they just list them in order of size? Industrials at 12.8%, financials 11.4%, healthcare 8.8%, consumer staples 3.8%, energy 3.2%, utilities 2.8%, real estate 2.4%, telecommunication 1.9% and basic materials at 1.5%. Let's take a look at their top holdings. Well, color me shocked. It's the usual suspects. We got Nvidia, Microsoft, Apple, Amazon, Meta, Broadcom, Google, Tesla, and Berkshire Hathaway. I couldn't find their breakdown of region exposure on their website, so I had to use Morningstar. We see North America at the top of 99.66%. Yikes. Talk about a total stock market. Everything else is under 1%, at Europe at second place with 0.26%. Since I'm a bit lazy, I'm going to check Seeking Alpha for the dividend growth and track record, and we will also do a comparison with the S&P 500 to see how VTI has performed the last years. Let's start with the dividend, and oops, a cut in 2020. Otherwise, we see a pretty nice trend the last 10 years. Their yield is hovering between 1.2% when it's overvalued and around 1.7-1.8% when it's more fairly priced. They don't write the growth for the 3, 5 and 10 year, but we can see it to the right. CAGR to 2024. 3 year around 7.5%. That's nice. 5 year around 5% and 10 year around 6.5%. So not too shabby. Let's check their performance against the S&P 500. I choose another Vanguard ETF, VOO. Their expense ratio is the same as VTI, and this is after taxes, dividend included. We see a pretty similar return, with VTI lagging the S&P 500 1%, give or take, unless since inception, where we can see S&P 500 annual return of 14.08% and VTI is sitting at 8.54%. The 1 to 10 year performance isn't bad at all, with annual returns of 12 to almost 19%. I think the performance is pretty similar since they are market cap weighted and the top of the S&P 500 is basically the same. Before we start finding European alternatives for VTI, I just want to explain why I don't like this kind of ETFs. It's the same with S&P 500. This is just my opinion, and you should not take that into account. Always see how an investment fits you, not me. Anyway, the performance is stellar, but the main problem is the dividend yield here. My goal is to live off dividends someday. Let's say I need $2,500 per month, that's 30k. Heck, let's say I need 50k per year if I want to live large. With a yield of 1.14%, that would mean I would need $4.3 million. Invested at 6% yield, that drops down to $833k. And if we went with a more moderate yield of 5%, I would need 1 million. So, maybe you will say, but if I sell 4 to 5% of my portfolio each year, then I could get the same income. I want to add that getting to a portfolio size of over 4 million is pretty hard, compared to say 800 to 900k. And yes, that is a good strategy, if the market allows it. If you have 4.3 million and the market drops by 50%, very likely it will. You're left with 2.15 million. Or even worse, say you invested around 1 million with the goal of withdrawing 4 to 5%. You would be left with 500k. Making that 4 to 5% withdrawal eat up more of your portfolio at a faster rate. Sure, downturns aren't forever, and even dividends get cut, but often not massively. So, for me, the only logical thing is to invest in a bit more of a high yielder. Alright, enough yapping, let's check out some alternatives. All of these ETFs will be distributing cash, since VTI does. The first one that comes to mind is Vanguard FTSE All-World UCITS ETF distributing. Now, the total expense ratio is a lot higher, but I just think that's what we Europeans have to deal with. It is 0.22%. The fund size is 17.7 billion euros. The total return since inception is around 345%. Let's check out their holdings. They have 3,603 holdings, and we see the same top holdings, except Berkshire Hathaway is replaced with Taiwan Semiconductor. The allocation is a bit smaller in the top holdings as well. Sector allocation is pretty similar, with the exception of tech at around 27% instead of 37%. Countries are a bit different as well, with United States and Canada, that is North America, is only at just above 60%. Maybe that's better, that's for you to decide. The dividend yield is 1.2%, so that's also pretty similar. For the dividend growth, I figured we will just do a spreadsheet, since getting growth numbers for European ETFs seems to be impossible, but we will save that for later. I should note, this ETF only invests in large and mid-cap companies. The second ETF is HSBC MSCI World UCITS ETF. Man, these names. Now, there are plenty of MSCI World ETFs, but most of them seems to be accumulating. I choose the largest ETF that is distributing. There was a small one with a total expense ratio of 0.06%, but we will have to do with 0.15%. The fund size is 11 billion euros. I think I'm reading that right. Looking at their holdings, we see it's quite a bit smaller with around 1300 holdings. But we see the usual suspect at the top. Sector allocation, pretty similar. Countries, a bit more in North America than the old world one. The dividend yield is sitting at a staggering 1.36%. Sorry for the sarcasm. We will save the dividend growth for later. Now, for the last one, I'm going to be boring, but hear me out. Vanguard S&P 500 UCITS ETF distributing. Now, you might shake your head, but to be fair, the total expense ratio is very low here at only 0.07%, and they have a fund size of 41 billion euros. They pay a dividend, the holdings are pretty much the same. Sector and country weighting is the same. The performance is better historically with S&P 500, and yeah, that doesn't guarantee future performance. The only difference is the number of holdings. 500 instead of over 3000, and the dividend yield sitting at 0.81%. But come on, does it make any difference when the VTI has a difference of 0.33%? You don't hold these ETFs for the dividend. So let's do a comparison with these three ETFs. Since 2012, this is the max time frame. We can see S&P 500 smoked the competitors with its 566% return versus HSBC's 391% and All World at 346%. So let's look at their dividend and growth. Starting with VWRL, this is the All World ETF. We can see it's a bit all over the place. The versus 2024 September is their dividend 2024 until September, and we can see we are at least beating that year to date. Their compounded annual growth rate doesn't look too good here, somewhere between 0 and the high 4s. The dividend yield is euro adjusted for all these ETFs since they are paying dividends in dollars. I'm going to speed run this a bit. Moving on to HMWD, the HSBC ETF. This looks more promising from a dividend perspective. A cut in 2020 like always, but the growth here is more stable, between the high 3s to over 8%. A good rule to remember is 7% growth is almost a double in 10 years. So your simple yield on cost would be 2.5% after 10 years if the growth is 7%. Yippee! Moving on to VUSA, or the S&P 500. They got 2 haircuts during this period, and the growth is similar to the Old World ETF, just a tad bit higher. Moving on to the valuation. I have to say, I hate valuing lower yielding ETFs, since I have to use a very high terminal multiple. That's their expected yield after 10 years. The higher the multiple, the lower the yield, and the yield does affect the valuation. Anyway, I'm going with their average yield the last couple of years. Starting off with VWRL. I'm using a discount rate of 10%. That's our required return. You can see the terminal multiple calculation to the right. The yield has been between 1.3% and 2% the last years. So let's use the high and lows here. And if we look at the valuation, I used a high multiple of 75. That's a yield of 1.33% after 10 years. To make a 10% return, you would need to buy this at 87 euros. So we just have to wait for a 35% drop to do that, and that is the best case. This is why it's very hard to value ETFs that isn't dividend focused, since the numbers are so small and the growth is almost non-existing. To value these ETFs, we would need the company's earnings, and that's pretty much impossible. Good luck finding the earnings of the over 3,000 companies. So I figured I would just show you guys their fair value, only based on their dividends and growth. So here we have the valuation, based on the dividend. I have a valuation ratio, where I divide the intrinsic value by the current share price. If it's over 1 and green, it means undervaluation. If it's below 1, it turns red. The lower the number, the more overvalued it is, and the higher the number, the more undervalued it is. When I invest for the dividends and fundamentals, not the hope that Fed cuts rates so prices go higher. Or for a bull market to continue. I make my investment decisions on calculating a fair price and buying below that, and focusing on real returns like dividends and earnings growth. It has to make sense. Now, if these were individual companies, I could just use their earnings or cash flow to make the valuation. But seeing how it's impossible to do that with an ETF, I simply do not invest, since it doesn't make sense for me. For the Vanguard ETFs, we are able to see both their PE ratio and their earnings growth. That means we can do a simple valuation using the PEG ratio, price earnings to growth. We simply take the PE and divide it by the earnings growth. For VWRL, the PE is 21.9 and their earnings growth 20.5%, making the PEG ratio 1.068. A number greater than 1 points to overvaluation, and a number lesser than 1 points to undervaluation. For VUSA, the PE is 27.5 and the earnings growth is 23.4%, so we get a PEG ratio of 1.175. So both are pointing to overvaluation. Will these ETFs have amazing returns? I'm sure of it, but in my eyes that's just speculation, since I can't calculate any fair value. So what's the conclusion? I would say, if you want a small dividend with a decent growth and price appreciation, I would choose HMWD. For just total return, I would choose S&P 500. I get that not everyone is a value investor and some people just want a set it and forget it investment. The S&P 500 has done terrific going back in history. You just need to be aware of the risks. No dividend to speak of to reinvest when we get a crash, and a big downside considering the holdings in these ETFs. If I were to invest in the S&P 500, I would invest monthly to dollar cost average. During all-time highs, I would allocate less, and when we eventually get a crash, I would go in with even more cash every month. It's hard to beat the S&P 500 over a long period of time. It just doesn't fit my investment goals. I hope you got some value out of this video. If you did, let me know in the comments. But that's it for this one. I'm the Swedish Dividend Investor, and I will see you in the next one. Stay smart, stay patient, and keep stacking those dividends. Ha det gött!